Okay, good afternoon, everyone. We will be starting in a minute or so, just waiting for everyone else to join. Quick sound check. If you can hear me okay, please type a 1 into the chat window. Thank you. Okay, I'm seeing plenty of ones. Thanks. Yeah, so we'll start in a minute or so. All right, let's get started. Good afternoon and welcome to today's First Trade educational webinar. My name is Prakash Vijayanath. I'm a senior analyst here at OptionsPlay. And today we are going to be going over, finally, the wheel strategy. Now, the wheel strategy is essentially a combination of the last two webinars that we have done. The first one being on covered calls and the second one being on cash secured puts. So what we're doing today is really amalgamating the last two educational webinars, which were focused on income, and the wheel strategy as well, also heavily focused on income and as a stock acquisition strategy. And we're putting it into one, and just to give you a better highlight of how this overall strategy, or how these two strategies essentially work together to help you generate a consistent income stream for your portfolio, and as well as allowing you to purchase stock at a discount. Now, quite a lot to get through here today. And before we get started, just a quick disclaimer. The types of securities, forms, and research tools used in this video are for demonstration purposes only and should not be considered a recommendation by OptionsPlay or a solicitation or an offer to buy or sell any securities. This video is not intended to be used for individual tax, legal, or investment planning advice. Now, also as part of the disclaimer, options do involve significant risk and are not suitable for all investors. Certain requirements must be met to trade options. So before engaging in the purchase or sale of options, investors should understand the nature of and extent of their rights and obligations and be aware of the risks involved in investing with options. So I have pasted a link in the chat window. This is just for just an additional disclosure document. So if you haven't read that already, please go ahead and read that. And I've just realized I have not shared my screen. Apologies for that. Here we go. You should be able to see it now. Sorry, guys. But yeah. All right. So our agenda for today. What is the wheel strategy? That is what we're going to be starting off with. Just to give a quick overview of the wheel strategy. During the last couple of webinars that we did cover the wheel strategy as well. But for anyone that's new here, for today's webinar, we will be giving you, what the wheel strategy is in a nutshell. And we will do that before quickly giving a quick review here on covered calls and cash secured puts. These are the two main components of the wheel strategy. So we will be going over their main definitions and why you would use them. From there, we'll be taking a more in-depth example of the wheel strategy itself in practice. We'll take a look at what, in my opinion, is probably the most important part of today's webinar, and that is finding the optimal covered calls and cash secured puts. The reason being is that this strategy, the wheel strategy, and its two main components, it's very much dependent on the strike selection and expiration selection. That really makes or breaks the strategy. So we will be spending some time on looking at what the covered call and covered puts are, optimal covered call and covered puts are. And finally, we'll quickly run over the OptionsPlay and First Trade reports for income that can help you with the wheel strategy and help you find some opportunities. So the main question I want to help you answer today is, how can I maximize yield and participate in capital appreciation using options? So quite a loaded question, but hopefully at the end of today's session, you get a better understanding of how the wheel strategy can help you achieve these two things. So what is the wheel strategy For those of you that did join the last couple of webinars, you should be quite familiar with this diagram that you see on the right-hand side. And for those of you that are new, well, the wheel strategy is essentially defined as both an income generating strategy as well as a stock acquisition strategy. So it's a very powerful strategy, and it's a great way to get the best out of buying stocks outright and using options to essentially enhance those stock returns. Now, the wheel strategy does help you create a continuous income stream. It also helps you purchase that stock at a discount. And therefore, you get to, because you own the stock itself, you get to participate in the upside capital appreciation of that stock. Now, you're going to hear me say this quite often during today's webinar, but it's something that I really want to hit home, is that you always want to prioritize participating in that capital appreciation of that stock. When you own the stock, you own it because you think it's going to move higher. And you have most likely, especially for the wheel strategy, you would need to have a long-term bullish view on that stock. So prioritize capital appreciation. Do not prioritize income. However, the income is just a cherry on the cake, if you will. I mean, it's always a good bonus. It's something similar to dividends. You don't purchase a stock solely for dividends. Most of the time, you purchase a stock because you believe that it could move higher, and the dividends are an added bonus. So that's how, sorry. Something in my throat there. But yeah, that's how you would look at the wheel strategy. Now, taking a look here at the diagram on the right-hand side, essentially this encapsulates what the wheel strategy is. It has the two main components in green. The top component, this is the first part of the wheel strategy, or the first step of the wheel strategy, is the cash secured put strategy. Now, this simply involves selling a put option. And when you sell a put option, you get to collect some premium for doing that. So that helps you to already generate some income for your portfolio. And from there, there's one of two things that can happen. There's two outcomes, right? That put option can expire worthless. So because you purchase a put option with a strike price below the underlying, the underlying stock may not decline below the strike price and may actually move higher or stay neutral. So in that case, the put option expires worthless. You get to keep your full premium, and essentially it becomes a bit of a rinse and repeat. You keep selling the put option, you keep collecting more premium if it keeps on expiring. However, what will happen is eventually you will get assigned because the underlying moves below the strike price by expiration. And when you get assigned, you have to purchase the underlying stock, 100 shares of the underlying stock. Now, this is an obligation because you are selling the option. You are therefore the passenger. You are not the driver in the scenario. And if you get assigned, you are obligated to purchase 100 shares of that stock. Now, assignment is always has a negative connotation in options trading, right? I mean, you always hear, you don't want to get assigned when trading options. However, when it comes to the wheel strategy and income strategies in general, assignment is not a bad thing, especially when done correctly. So in the case of selling a cash secured put, you very much welcome assignment. You want to get assigned because ultimately you want to purchase 100 shares of the underlying stock. This is because you only sell put options or cash secured puts on stocks that you believe have long-term bullish potential. That is a key, that's a key motivation for the strategy. Even though it's a great income generating strategy, you will be owning 100 shares of the underlying stock, and therefore you have to have a long-term bullish view on that stock. So let's say you get assigned, you are now long 100 shares of that stock. From here, this is where the covered call component comes in. You simply sell a call option on that stock, you use that stock as a collateral, and you therefore collect some premium. Now, again, one of two options can happen. Remember, you're selling a call option with a strike price well above the underlying price of that stock. So let's say, for example, the stock does not rally that much, or it doesn't rally enough to reach that strike price. The call option will simply expire worthless. I mean, you get to keep the premium that you collected, and again, it becomes more of a rinse and repeat strategy, continuously collecting premium. And eventually, what's going to happen is, like with a cash secured put, you will get assigned. Eventually, the underlying stock will rally to the strike price. Now, when you do get assigned, you have to, because you sold a call option, you have to sell 100 shares of the underlying stock, which you already have at that strike price. So when you look at this, the wheel strategy, you know, in a nutshell, you can see how it really impacts these 3 points on the left. The put option and the call option, selling both of them helps you generate a continuous stream of income, right? When it comes to purchasing the stock at a discount, that's what the cash secured put helps you do. It's because you're selling it. There's 2 reasons for that, really. One, because you're collecting premium. It helps, you can use that premium to offset the cost purchase of the underlying shares. And also because you are selling a put option with a strike price that's below where the underlying currently is, what happens there is that you are essentially forcing yourself to buy the dip, right? The underlying has to decline a little bit for you to get assigned, and you're not, you would naturally get a better purchase price when selling a put option. Obviously, the risk here is that the underlying does not decline and actually moves higher. But yeah, that is the risk of a cash secured put. There's a bit of FOMO, is, you know, the fear of missing out on a rally. You have to have a neutral to maybe slightly bearish outlook when selling a put option in the short term, but a long-term bullish outlook. Now, once you own the shares, from there you participate in the capital appreciation. And like I said, this is always the priority. Capital appreciation will always earn more than income received in the long run. In the short run, sure, the underlying stock declines. I mean, this collecting premium from selling a call option will certainly soften the blow. But in the long run, participating in the capital appreciation will always win. So that is the most important thing about this strategy. It's that it still is very much a stock strategy, if you will. It's just using options to enhance it. Okay, now, what is a covered call? Just a quick recap here of a covered call. Now, a covered call does require 1 prerequisite, right? It requires you to own 100 shares of an optionable stock or an ETF. From there, you would sell a call option using that stock or an ETF as collateral, and you receive a premium in doing so. This creates an obligation to sell the stock or ETF at a specific price. So pretty much what we were talking about in the previous slide. Now, when it comes to a covered call, it is still a bullish strategy. And many investors get this wrong. Many investors think, okay, I'm selling a call option with a higher strike price. I do not want to get assigned and are happy with the stock actually declining because their call option expires worthless and they get to sell another one eventually and receive more premium. And while I could see the logic in that. However, like I said, always prioritize the capital appreciation, because when it comes to a covered call, it is actually a moderately bullish strategy. Now, the blue line here on this P&L chart, this represents a long stock position. You can see, obviously, the more the underlying stock rallies, the higher the profit is for naturally for if you're long 100 shares of stock, correct? Now, when it comes to the covered call itself, it does have a bit of an inflection point, and that, or in other words, a max gain. The reason for that is because there's a strike price, and the strike price, once an underlying hits that strike price, it's the overall position. The profit kind of caps off there, because if the underlying stock rallies past the strike price, you will get assigned, and therefore you do not have that upside exposure past the strike price. So even if the underlying stock does rally a little bit here, you still have that bullish exposure, and that's actually the best outcome, a moderate rally where it expires just below that strike price, because then you maximize your capital appreciation while also not having to sell your shares. The other thing when it comes to covered calls that we need to talk about is, getting assigned isn't always a bad thing when it comes to covered calls. If you do it correctly, chances are you've probably made a good profit on your stock purchase, by selling a covered call at a higher price than what you purchased the stock for. And by selling a covered call, with a high enough strike price, you get to max out or really participate in a significant chunk of that capital appreciation, as well as potentially selling it at an overbought condition. Now, we'll get more into that in a few slides, what I mean by that. So if you're a little bit confused about that, don't worry, we will discuss that in further detail. Now, the break even does move a little bit to the left. And the reason for that is the premium you receive from selling a covered call can be used to offset the cost purchase. And naturally, you have some substantial loss potential. At the end of the day, the stock can always decline down to zero. Highly unlikely, but it can still happen. And that's the game you play when you own shares, right? Now, when it comes to cash secured puts, so the prerequisite here for cash secured puts is to have cash readily available to buy 100 shares of that stock or ETF. Now, when you go into the strategy, you are doing this because you want to get assigned and you want to own 100 shares. By selling a cash secured put instead of simply buying using a limit order to purchase the shares, you get to receive a premium on top of that. So always important to have cash readily available to buy the underlying stock or ETF. Now, if you sell a put option, you can sell a put option, you use the cash as collateral, and you receive a premium in doing so. So it is still an income generating strategy as well as a stock acquisition strategy. And this creates an obligation to buy the stock or ETF at the specific price or the strike price. Now, the P&L chart for a cash secured put is very similar to that of a covered call, because at the end of the day, you are selling a put option. This is a neutral to moderately bullish strategy in itself. And it is, again, profit is capped at the strike price. So going over a quick example here of a simple stock purchase, something I'm sure we've all done. We have stock ABC trading at around $50. And let's say I'm bullish on stock ABC. So I place a buy limit here at 50. It gets executed, so I purchase the shares at $50 a share. And I place a sell limit at 58. I don't think the price is going to move that much further. I think that's going to be a nice take profit zone at 58. Now, what does this mean? It simply means I've risked $5,000, which was a purchase price of 800 shares of ABC. And my reward here is 800, because I made $8 a share here profit from this rally from 50 all the way to 58. So quite simple, quite easy to understand. Now, let's go over an example and compare essentially what the previous example there of a stock only trade, and compare the performance of having essentially an identical outlook, but using options to really enhance this trade setup and enhance the P&L. Now, we have two investors. Let's call the stock only investor, investor 1, and the stock and options investor, that can be investor 2. And same example, ABC trading at $50 a share. Now, both investors are bullish on the stock. They both have 5,000 in cash to buy 100 shares of ABC. And investor 1 naturally, would simply purchase a buy limit order, or execute a buy limit order for 100 shares of ABC at $50 a share. This immediately gets executed, and they are therefore debited 5,000. Now, the investor 2, they're going to use options, right? So they're going to say, I'm going to sell one put option of ABC with a strike price of $50, and it expires in around 30 days from now. And doing this, I receive $3.15 in premium. This is on a per share basis. So in reality, you're receiving $315. So what does this mean? It means that investor 1 now already has 100 shares of ABC. Investor 2 is credited $315, has 5,000 in collateral set aside, and he now has an obligation to purchase 100 shares of ABC at $50 a share, which is the strike price of this put option. Now, if you take a look at the graph on the right-hand side, you'll see how immediately this has a positive impact in terms of your risk to reward. That $3.15 per share can be used to offset the cost basis of the purchase, right? So from $50, if you generate $3.15 per share in premium, you can use that to offset that $50 purchase price per share. And this means that your new break even, or your option break even, would be at $46.85. So it's been decreased by $3.50 per share. Whereas the stock break even, when you buy a stock, the break even price is naturally the purchase price of that stock. So immediately you are risking less by using that premium you received to help fund the option break even. or the option, the stock purchase, I should say. Now, let's say on day 30, 30 days from now, ABC has rallied by 2% to 51. What happens here is, the investor one, still has 100 shares of ABC, and they were up $100, so that's 2%. That represents a 2% unrealized gain. When it comes to investor two, that put option is now expired, and it's expired worthless. Why? Because ABC did not decline below that $50 strike, and therefore that put option was not assigned, or was not executed, and therefore investor two was not assigned. So this expires worthless. Investor two still keeps a full premium of $3.15, and this represents a 6% gain already compared to investor one, with so far only a 2% gain. Now, that was an expiration Friday. Now, the following Monday on day 33, investor two decides to sell another put option, this time with a strike price of 51. Therefore, has to set 5,100 in collateral to purchase 100 shares at $51 a share. ABC is still at 51, and investor two now receives an extra $3 again in premium. Now, already you can see the gap here between the stock break even and the option break even has now been reduced to 44.85, because again, the premium received from selling these two put options can be used to offset that initial purchase price of 51 a share, the new purchase price of 51 a share, should this put option actually get assigned here. So 30 days later, ABC has declined a little bit back down to 50, back to where we started. And now, what does this mean for the unrealized P&L of these two investors? Well, investor one is back to break even. After 2 months of trading, back to break even because ABC is at his purchase price. Investor two, on the other hand, gets assigned. This means that he has to purchase 100 shares of ABC at $51 a share. So even though ABC is trading at 50, he has to purchase it at 51. Now, this means that the 5,100 in collateral is used to purchase those 100 shares. And still, it's important to remember that even though the 5,100 was used to purchase this 100 shares, the actual break even for investor two is still 44.85 because of the two instances of receiving that premium of 315 and 300. So they are therefore debited 5,100, and now investor two owns 100 shares of ABC and is currently up 10% on this overall position because of all that premium received. Now, let's say, on the following Monday, investor one has had enough, that he wants to get rid of his stock, and he places a sell limit order at 58, with a 58 limit, I should say. Investor two as well, he wants to get rid of his stock. He doesn't necessarily want to get rid of his stock, but he's open to getting rid of his stock, but he wants to generate a premium in doing so. So what he would do is simply sell a 45-day call option with a strike price of 55. And in doing so, receives $2 in premium. So it's credited another 200 in total. Again, this can be used to help reduce the option break even relative to the stock break even by another $2 a share. This means that investor two is obligated to sell 100 shares of ABC at 55, but again receives another 200 in terms of premium. Now, 45 days after that, ABC has now rallied by 4% from 50 all the way to 52. Investor one is up by 4% or $200 unrealized gain, and is still very much in the trade. Remember, he's selling at 58. And investor two sees his call option expire worthless. So the underlying stock did not rally enough because it's at 52, and this has a 55 strike here, the call option. So therefore, it expired worthless. Investor two still keeps it full premium, and the following Monday decides to sell another covered call. Now, this time the strike price still remains at 55, and it's still the same premium of $2 a share. And again, it further reduces that option break even. Now, 45 days after that, ABC had a massive rally, maybe an earnings announcement came out, but it's now at $60 a share. So that represents a 20% gain here, or $10 gain for ABC from 50. Now, investor one, because he placed a sell limit order at 58, is therefore credited 5,800. And investor two gets assigned on this call option. This means that he has to sell his 100 shares of ABC stock at 55, not 58 compared to investor one, but at 55, because that is a strike price of that call option. And because of that, is credited 5,500. So what does this mean all in all if you look at the actual numbers? Well, investor two, despite them both having pretty much identical exposure to ABC, investor two was able to generate a significantly higher profit by simply selling options and generating some additional income to not only reduce the effective purchase price and the break even, but to optimize that risk to reward. Investor one is up by $800, which represents a 16% realized profit, whereas investor two is up $1,415 because of the purchase price being at 51 and the selling price being at 55. But in addition to that, the premium received along the way. And this represents a 28% realized profit here for investor two. So even though they both had identical exposure, and even though investor two sold at 55 compared to investor one selling at 58, investor two was able to generate a significant higher profit by utilizing options. So let's discuss the optimal trade setup here for the wheel strategy, starting off with covered calls. Now, I'm sure many of you that have joined my webinars in the last month or so is very familiar with this slide. But what we have here is block trading at $83 a share. And when it comes to looking at the optimal covered call, we've done a lot of the heavy lifting for you. We've done a back test from 2008 all the way to 2022. And we're looking at different combinations of strike prices and expiration dates. And I can tell you, the expiration date that yielded the best results was 45 days to expiration, as we used in the example previously. This is because, the covered call strategy benefits from theta decay, right? You want that call option to expire worthless, or you want it to lose value. Now, at 45 days, that's when the theta decay starts to accelerate. If you sold a call option that's 90 days out, what happens is, you generate more premium, but there's no theta decay. So you'll notice that if I sold, a call option, a 45-day call option, let it expire, and sold an identical call option another 45 days, resulting in a net 90 days in total. And if I compared that to selling one 90-day call option, you'll notice that by selling the two 45-day call options, you actually generate more in premium because of that theta decay, or the accelerated theta decay. So that's why 45 days is a sweet spot. If you go the other end of the spectrum, very short to expiration, you do generate some premium for that, but not a lot, and not enough to warrant the risk of selling your shares. Remember, you want to hold on to the shares for a bit longer. You want to participate in the capital appreciation, and selling, going very aggressive with maybe 10 days to expiration, or even 5 days to expiration, it just doesn't generate enough premium for taking on that risk. So 45 days, that is the optimal expiration for a covered call. Now, when it comes to the strike prices, we have 3 different strike prices here to choose from. The first one is the 110. I mean, the scale here on this chart isn't great, but let's say the 110 is over there. This collects $1.19 in premium, 119 in total. This means there's a raw return here of 1.53 and an annualized return of 13.38. So the raw return is simply the premium received divided by divided by the 110 strike price. The annualized return is simply the raw return over an annualized period. So if I did the exact same trade, 45 days to expiration, and received 119 each time over a 1-year period, I would generate 13.38 in total 30.38% in total. Now, this is the 15 delta strike. So the 15 delta, we all know what delta is. Delta represents the change in the options price relative to a change in the underlying. However, another way of looking at delta, especially when options trading, is that it can be used as a probability of the price reaching that strike. So the fact that the 110 strike has a delta of 15 means that there's a 15% probability of block rallying all the way to that 110 area or the 110 price. Important concept to remember. So it's a fairly low probability, especially when you compare it to the other options that we have here. So the other option here is, or other strike, I should say, is a 101 strike. This is, let's say that's over here. And that is the 25 delta. It collects a bit more premium in 247, raw return of 3%, and annualized of about 28.5%. But this is a 25 delta. So a higher delta means a higher probability of the underlying reaching that strike price within the lifetime of this contract. But you're compensated accordingly because you generate more premium. Now we have the 91 strike. This is a 40 delta, so quite a significant probability of getting assigned, or the underlying price reaching the $91 level. In this case, you would collect just under $5 worth of premium. Your raw return would be 6.35, and you analyzed 66.71. So the further higher you go, or the more conservative you are, the less premium you receive, and the closer you go, or closer to the actual strike underlying price, the more premium you receive because you're compensated for taking on a bit more risk in terms of risk of assignment. So out of these three options, using the chat window, could you please tell me which delta do you think is the optimal for a covered call? Is it the 15 delta, 25 delta, or the 40 delta? I'm interested in seeing what you guys think, or how you guys think. So yeah, please use the chat window. Okay, seeing some mixed results here between 15 and 25 delta. Mostly no one really going for the 40 delta, even though it collects more premium. I mean, it must be tempting, but for those of you that said 15, you are indeed correct. By using a conservative delta or selling a conservative call option with a conservative strike, naturally, you actually generate a higher profit in the long run. Now think about it this way. Remember what I said earlier in this webinar. You always want to prioritize capital appreciation. So let's say I purchased the stock at $80 a share. And if I'm selling it at 110, I've made a $30 per share profit already. Yes, I generate less premium compared to the other options out there, but if we add that in total, it's $31.19 there that I've generated from this by selling the 110 if I get assigned, because the underlying has to rally so much more, and therefore I'm participating in so much more capital appreciation in doing so. Now, when it comes to the 101 strike, it's only rallying, it's rallying a little bit less, right? It's not going as far as the 110. I'm receiving less premium in total. And if you do the maths on this, purchase price of 80, I'm making $21 on the sale of the shares itself, plus an additional 2.47. So it's still less than using the 15 delta core if I get assigned, because there's a lot more room to the upside for the capital appreciation, and that far outweighs the increase in the premium received by using a more aggressive strike. Now, the 91 delta as well, no one actually went for the 40 delta, I should say. No one actually chose that as a choice, but that is a lot more aggressive, and there's a very high probability of that getting assigned. And you're participating in the least amount of capital appreciation. So always prioritize a lower delta. 10 to 15 delta is generally a good delta range to look at, because it helps you participate in the capital appreciation. And if you don't get assigned, well, guess what? You can sell more. You can sell another 15 delta and let it expire worthless, and just keep generating that consistent income stream for your portfolio. This in the back test was the optimal delta because it helped because of the capital appreciation. It helps you participate in that capital appreciation. So when it comes to the optimal covered call, 45 days to expiration and 10 to 15 delta, I would say somewhere around there. But the logic is that you are more conservative with your delta to maximize capital appreciation. All right, so taking a look at the optimal short put. Now, our backtest showed that the optimal expiration here is 30 days. So you're actually going a little bit more shorter on the shorter side of things when it comes to selling a cash secured put. And again, we have three different options here. We have the 142 strike here for a stock that's currently trading at 145. So very aggressive, just under where it's currently trading. Sorry, that's not accurate. It's the 142 there. We have the 134 strike, which is a good bit lower from where HC is currently trading at 145. And then we have the 126 strike, so even lower. So 142, a more aggressive delta of 40, it collects the most premium because it's a higher probability of that getting assigned. And as you go down the strikes, it collects less premium, but there's a lower probability of getting assigned. Now, naturally, the more aggressive delta generates the most raw return. That 6.55% represents the premium received divided by the strike price. So your effective, it measures the discount price that you're getting for the stock. By collecting 873 in premium, you are discounting your effective stock purchase because you're using that 873 to fund this 142 purchase per share on a per share basis, which is represented by this raw return of 6.55. Same exercise. Which delta do you think is the most optimal for a cash secured put? Is the 40, 30, or the 20 delta? Please use the chat window. Okay, so most people are actually going for the 20 delta here. And unfortunately, that is incorrect because when it comes to a cash secured put, you actually want to get assigned. Remember, that's what I said in the beginning. You want to get assigned because you want to participate. You want to own the shares and you want to participate in that upside capital appreciation. That's why when it comes to cash secured put, the 40 delta is actually the better delta. It's a more aggressive delta. But it increases the probability of getting assigned. And yes, it's always good to receive a bit more premium in doing so. So when it comes to the optimal short puts, the best expiration is 30 days to expiration, and you generally want to go a lot more aggressive with your deltas. You want with your strike price. You want to you want it to be closer to the actual price of the underlying because you want to get assigned and you want to start selling covered calls. So more aggressive delta, 40 to even 45 delta, I would say, would be ideal for a cash secured put. All right, so let's quickly go over the income opportunity reports that we have for you in partnership with OptionsPlay and First Trade. So we have developed a few income reports, and when it comes to the wheel strategy, there's two reports that you can use. There's a covered call report and the short put report. So you simply click on research and tools and click on options, and we will get taken to this page. Now, starting off with the covered call report, what we do is we scan, hundreds of symbols, all symbols in the S&P 500, as well as very liquid ETFs. And we look, by using our settings or optimal covered call settings of around 10 to 15 delta and 45 days to expiration, or as close as possible to that, we generate the optimal covered call. So this is very helpful and can help save you a lot of time just by using this report, because if you do want to sell a covered call on a stock that you own, you can simply use a search bar to find the optimal covered call setup based on our best practices. And it has all the information that you need, right? So let's say you own 100 shares of Lyft, and this covered call report is telling us to sell the $15 strike price with an expiration date on the 16th of June. The mid price for this is 32 cents. So The mid price is the price between the bid and the ask. It's the most competitive price that you can get for selling this call option. It has an IV rank of 68. IV rank is the implied volatility rank. It measures the implied volatility of lift currently and compares it to the last 1 year of implied volatility. So it's a great way of actually measuring apples with apples because you can get a better sense of what the implied volatility actually is. Different stocks have different implied volatilities. Like a consumer staples stock compared to a technology name or a growth name will have lower volatility, right? So lower implied volatility range. Whereas by using the IV rank, it compares the current implied volatility to the implied volatility over the last 1 year. And the higher it is, it means that it's closer to the top part of the range. The lower the implied volatility is, or IV rank is, it means that the implied volatility is closer to the bottom part of the range over the last 1 year. The IV rank really just helps us, see how much bang we're getting for our buck, because it's not necessarily a determining factor in terms of choosing whether to sell a covered call or not, but it just indicates that a higher implied volatility means that options are going to be more expensive, and therefore I'm getting more bang for my buck by selling rather than, let's say, buying an option if I wanted to gain exposure by buying a call or a put option. So high IV means that options are more expensive, and therefore it makes sense to sell. In terms of income, though, your only option is to sell. So it doesn't really make too much of a difference here, but it's always important to know that. Now, we do have these two columns here for earnings. An earnings flag is a yes or no variable. There's no earnings until during the lifetime of this contract, and it's yes if there is an earnings date during the lifetime of this contract. You have all the other information that you need: the stock price, days to expiration, the raw and annualized return, and of course the distance to strike. This is a very helpful number. It tells us how much the stock needs to rally to actually reach that strike price and potentially get assigned. So if you click on the trade button, it will auto-populate this trade ticker here for you. And a very similar case here with the short put report. Short put report, many people I think kind of get confused and use it as a screener for stock ideas. And it's always important to realize that, look, this isn't a idea generation tool. It's an idea generation tool in terms of getting the best option trade suitable for a stock that you're looking for, but it doesn't help you necessarily. It doesn't only scan for bullish stocks or anything like that. So let's say, for example, we have Roblox, and Roblox is a company that I'm very much interested in. I think that there's long-term potential, and I want to buy 100 shares of it. So I can simply scroll down or use a search bar and type in Roblox and get the optimal short put setup here for Roblox. And again, gives you all the information that you need, including the distance to strike, which in this case is only 1.5%. So Roblox only has to decline 1.5% to reach my strike price. So the big difference in terms of the two reports is a distance to strike column, because you'll notice that the percentages are a lot lower, because when it comes to a cash secured put, you want to get assigned, so you use a more aggressive strike price as opposed to a covered call where you don't necessarily want to get assigned, or if you do get assigned, you want to max that capital appreciation. Okay, so that is everything for today. Thank you guys so much for joining me. I am going to open the floor for a couple of minutes just for a quick Q&A. Please use the Q&A window. So if you have any questions on today's webinar, please let me know in the Q&A window, and I'll try and answer them for you. Okay, so how is IV rank used? Yeah, so IV rank, it's a better tool for determining whether you want to sell an option or you want to buy an option. So let's say I have a bullish view on a stock, a bullish view on Apple. So if I have a bullish view, everyone would normally go to a debit spread, right? You buy an at the money call option, you sell an out of the money call option, It helps you reduce your risk, and you have bullish exposure to Apple. But what happens if IV ranks extremely high? It means that the implied volatility of Apple is high. There's going to be a huge implied move. And therefore, the options are a lot more expensive, meaning that if I were to buy an option, I have to spend a lot more than I would normally. And in that case, I mean, it makes more sense to actually use a credit spread, for example, by selling an at-the-money put and buying an out-of-the-money put. I still gain some bullish, neutral to bullish exposure, but I'm making more bang for my buck because I'm now, instead of buying and paying to have that bullish exposure for the debit spread, I'm actually selling and receiving that income, and it's more income that I'd usually be receiving for that for selling a credit spread on Apple. Now, naturally, each strategy, these are two different strategies, but it's a good way to determine whether you're an option buyer in the current market or you're an option seller. Can we get a record link for reviewing again? I'm sure you can. Just speak to First Trade customer service. I'm sure they can get that sorted for you. What was the optimal time frame for cash secured put? That would be 30 days. Please include delta dates in the reports. Thank you. I'm not sure what you mean by that, but the delta would naturally be, it's a report that's updated hourly, and we use a 10 to 15 delta there. So whatever the 10 to 15 delta is at the time of the update would be the strike price. All right, guys. Well, thank you so much for joining me today. I hope you learned something about the wheel strategy itself. I was very excited for this webinar because we've been building up to it now for the last month, with doing the cash secured puts and the covered call webinars. So this is a very powerful strategy to use in conjunction with your longer term investing, and I think that's what makes it so helpful, is that it's not just pure speculation, it's additional income for your portfolio, and especially during times of market distress, like last year, for example. That was a great time for income generation, because even though stocks were declining, that income generation was helping to soften the blow. So again, thank you so much for letting me present this to you today. I hope you all have a great remainder of the week. And yeah, I will see you next week for a Tuesday market outlook. Thank you, guys. Bye.